Welcome to Chapter 3, Financial Statements, Cash Flow, and Taxes. And in today's chapter, we'll introduce you to some of the key financial statements and discuss the importance of cash flow and taxes to a business. So as you would recall that we had discussed, the manager's primary goal is to maximize shareholder value, which is based on firms' future cash flows. But how do managers decide which actions are the most likely to increase those cash flows? And how do investors estimate future cash flows? The answer to these lie in the study of financial statements that publicly traded firms must provide to investors because these are publicly traded firms. So from these statements, investors, including both, the institutions, the financial institutions such as banks, insurance companies, pension funds, and individuals may make an informed decision about investing in a firm or understanding how the firm is performing financially. So this is going to be the bulk of discussion today, for Chapter 3. So we'll discuss about key financial statements, which are the balance sheet, the income statement. We'll also talk about the statement of stockholders' equity or the shareholders' equity and the statement of cash flows. We'll discuss about the concept of free cash flow and the federal tax system, and talk about the tax structure. Okay. So the annual report, as it's normally referred to, and I did discuss that publicly traded firms must provide to investors the annual report, which primarily includes these financial statements. They include three main financial statements and a discussion on statement of stakeholders or stockholders' equity. So the first one is the balance sheet, which provides a snapshot of a firm's financial position at one point in time, and primarily this lists all the assets, all the liabilities, and the stockholders' equity, and we'll discuss with an example shortly. The income statement, on the other hand, summarizes a firm's revenue and corresponding expenses over a given period of time. And you find why I chose to use the word corresponding, because of the accounting principle that mandates that expenses that have incurred to generate a certain revenue must be reported correspondingly. So we cannot, for example, have expenses reported for revenue which would be generated in the next period. So it has to be a matching principle. The statement of cash flows reports the impact of a firm's activities on cash flow over a given period of time. So simply saying the source of capital, how it's coming in, and how it's leaving a firm, that provides a statement of cash flow. And then a statement of stockholders' equity shows how much of a firm's earnings were retained, that is, retained for ongoing operations and business, rather than paid out as dividends. So let's begin with an example of a fictitious company, DeLeon Incorporated. Let's assume it's a snack food company that underwent major expansion in 2014. So far, expansion results have been unsatisfactory. Why? Because the company's cash position is weak. And that could be for many reasons, as we'll try to investigate by looking at the financial statements. And thereby, you'll get some exposure to how to read the financial statements and how to make a informed decision as to compare between financial statements of two periods. Now, since the company has underwent a expansion, I'm assuming that a lot of funds were spent on this expansion project. So, but we'll see in the financial statements to follow. The suppliers are being paid late. That is a cause of worry because suppliers who supply raw material for production have to be provided funds on an agreed upon or in an agreed upon time frame. So remember, most of the businesses, unlike how we are used to purchase, for example, most of the time when we purchase a product or service, we normally provide cash or a check to be paid out immediately or through a debit card or a credit card, which necessarily provides funds to a business immediately or in a period of 2 to 3 days. However, in business environment, most of the businesses, they would work on a 30-day or 60-day credit. So suppliers, when they are already stretched out, as they are given a 30 or 60-day credit, because they also have to provide funds to their workers, pay out utility bills, or to their own suppliers, are stretched out themselves. So this could be pretty detriment to an ongoing business operation if you are stretching beyond a contractual or agreed upon time frame with respect to payment. The bank has threatened to cut off credit, and that too again, normally banks would provide a time frame for a short-term credit to business for ongoing operations because, things like, for example, a business may provide products or services to their clients with probably a 30 or 60-day credit, and the bank might provide funds to, fund this time frame when the money is awaited. And if that is stretched out, the bank may threaten to cut off credit, saying, well, you're delaying beyond a contractual time, so we are not going to extend our credit on a long-term basis. The board of directors have ordered the changes, and that must be made. So, for example, remember we discussed about the managers and the chief executive officer. Normally, they are running a firm at the will and discretion of the board, which represent the shareholders. So the board oversees the overall running of the firm, and in case they're not happy, they'll communicate that to the top management team, and that has to be taken care of. Otherwise, the management team will be replaced. So let's now start looking at each of those financial statements and make some comparisons. So in the first instance is the balance sheet, and balance sheet obviously, if you look at the balance sheet's identity, it's assets. So it's assets equal to liabilities plus shareholder equity. So that is the basic identity, and you'll get to know as we discuss what the comparison is like. So let's start with the cash. And remember that the balance sheet is organized in the order of liquidity. Liquidity you can refer to like liquid, water, how easily an asset could be converted into cash without replacing too much of its original value or inherent value. So for example, if I want to, let's say, liquidate my T-bill treasury bill certificates. They have a ready buying or ready market available, so it's as close as possible to cash. Obviously, cash is going to be the most liquid asset because cash is cash. It doesn't require any loss of value for conversion into cash because it's cash. So the T-bill, obviously, they have is a ready market because it's backed by the U.S. government. Inherently, it has very little risk. So again, there is an active market which is going to be ready to purchase or sell T-bills, but there is going to be some transaction cost. There's going to be some, you can say, loss in value, for example, if you want to liquidate at a short term or short period of time. And so forth. For example, physical assets are pretty hard to convert into cash, even though you can. For example, if I want to sell my car, which on book may be worth $15,000, and if I'm pressed for cash, and if I say, hey, I want to sell this car for $50,000, I may not have many ready buyers. But if I, let's say, hey, if I wish to sell it immediately, take it to a dealer, and dealer offers me $10,000, that's going to be a loss of $5,000 from the book value. But this is going to provide me with cash. But going by the definition of liquidity, it has substantially lost in value. So in that way, physical assets are least liquid. Cash, T-bills, stocks in certain instances, bond certificates in certain instances, they are relatively more liquid. So starting with, or going by the order of liquidity, we start with cash, and let's start comparing and see what the concerns that we just discussed really look like. So we have obviously 2014, when the business, DeLeon business, went on a major expansion project, and then this is the situation in 2015, and you can see the comparison. Cash has dwindled because of expansion, and from 57,600 in 2014 has come down to 7,282. Obviously, there is a shortage in cash. Now, accounts receivables, this is the amount of funds that is owed from our clients. So basically, business would make sales, again on credit, and this is the amount which is awaited from our clients, accounts receivable. So this is awaited, that's why the word receivable. In 2014, this amount was $351,200, but then it increased to $632,160. So obviously, yes, we did good on sales because obviously we must have done good on sales. That's why we have such a high amount of accounts receivable. But on the downside, this is the amount that is still awaited. And this is the reason why the banks and the board seems relatively unhappy, because we are not able to realize this sales that we have made into cash. So why does this happen in the first place? I mean, this could be because there might be pressure coming to the marketing team to go out and make sales, and the marketing team, in their enthusiasm, might have given a longer than required credit, time frame to suppliers, to the clients. Inventories are the goods which are finished and they are lying in the warehouse. That is, these still have to be booked. They still have to be sent outside the warehouse, that is to go to the clients. So again, it was $715,200 worth in 2014, and it's gone on to $1.2 million approximately in 2015. Is that good or bad? I mean, obviously, doesn't seem too good because now you have almost $1.2 million worth of goods lying in warehouse which hasn't been sold. So that is another account of worry for the board, the bank, and investors, because you do not wish to accumulate too much of goods in inventory. Now, just to give you a very practical example, I'm sure all of you are aware of a company called Dell, which manufactures computers, and the company really revolutionized the way computers were manufactured. They introduced the just-in-time method for manufacturing laptops and computers. That's why they were able to heavily discount the price of desktops and laptops. They became a market leader by this innovation. Obviously, the way it worked was Dell never had finished goods lying in their warehouse. So each and every laptop, each and every desktop that they manufactured would be done once the order was placed. So normally, and I'm talking about, the time frame which was 10 years ago when Dell did not have their laptops or computers selling through electronic, retail stores such as Best Buy and so forth, or have their own franchise, like Walmart through Walmart and their own stores. So each time you had to purchase a Dell, you had to call in, and a customer rep would sit with you over the phone and configure a laptop or a desktop. And once the order was placed, it would take normally 10 to 14 days for order to be shipped out to you. For the wait time, obviously, you would get a heavily discounted product compared to a laptop or desktop which you could buy off the shelf at any of these electronic stores. Now, this obviously revolutionized because at the very moment you placed an order, each and every product part was ordered by Dell to its vendor. For example, hard drive, the screen, the casing, the keyboard, or other peripherals or accessory, they were ordered at the same time. This way, Dell was able to control its order of inventory. So I thought, this could be an interesting aspect for you to understand. So the total of cash, accounts receivable, and inventory is the total current asset. That is the asset which could be converted into cash easily. But in reality, you really cannot convert inventory easily into cash because sometimes certain products will not sell. That's why you have, car dealers heavily discounting, the prior year cars at the year end, or at, clothing stores, you'd find heavily discounted clothing at the season's end and so forth. So even though you find that the current assets are significantly higher in 2015, but as we discussed, a bulk of it is locked between inventory and accounts receivable, which in effect should not be this high. Gross fixed asset, so we're talking about building, plants, physical assets. And as we had discussed, because of the expansion that happened, it has substantially increased from 491 in 2014 to 1.2 million approximately in 2015. Less depreciation, which is the charge back that the company is allowed to take for wear and tear and replacement cost. So you can think of it as a replacement cost. For example, if a machine works, for a year, then it does have wear and tear. So the amount that is allowed towards wear and tear, you can think of it as a replacement cost, can be charged back. So basically, it's an expense, as you would later on realize. It's an expense that the company does not pay anyone, but keeps for itself as a replacement cost for the machine or plant or physical asset to be replaced, at a certain point in time. Now, the depreciation, since it's a percentage of your fixed asset, so obviously it's a higher number than 2014. So net fixed asset is going to be 1.2 million approximate minus 263,160, so 1,202,950 less 263,160 is going to be 939,790. Total assets are going to be the total of net fixed asset plus total current asset. So this is 2,866,592 in 2015 and 1.4 million approximately in 2014. So on paper it looks good, but I explained the specific areas which are a reason for concern, primarily because of the inventory, primarily because of accounts receivable, and to a certain extent gross fixed asset, because if you were to compare how businesses function these days, none of the businesses you find would have their own plants and machineries these days. Why? Because they do not want to deal with the fixed costs and the amount of money that gets blocked by investing in these physical assets, machine, and so forth. They rather have it manufactured by a third party and being billed as an expense, per unit. Why? Because let's say if a company is gambling with a new product, now obviously they'll invest billions of dollars in setting up a plant, machine, and so forth. What if the product fails? The company is now going to be tied up with that $1 billion worth of investment, and now they can't recoup as they had thought. By outsourcing to another firm, yes, they might be paying a little bit more because it's a third-party manufacturing, but the company has not blocked its own investment in building a plant, machinery, and so forth. Now, take the examples of Apple. I mean, Apple is a hugely successful firm. If they want, they can have their own plant manufacturing their cell phone, which is immensely popular. They can have their own plant manufacturing their, MacBook Pro and so forth. Yet they concentrate only on research and development, retail and marketing, supply chain and so forth, strategy of course, and have the third party, which are some manufacturing centers over in China, assemble these products. And interestingly, the cell phone, the Apple's iPhone, immensely popular iPhone, it uses parts manufactured in almost 40 different countries. So the screen comes from one country, battery comes from another country, chips, for example, the Wi-Fi chip or the LTE chip comes from maybe another country. The PCB might be coming from another country. The casing, aluminum casing, might be coming from another country. The glass cameras or the sensors. So it's a pretty intricate piece of equipment. That's why it's so expensive. Has origins in almost 40 different countries, and Apple does not manufacture any of those. It concentrates only on R&D, design, retail, marketing strategy, and so forth. So let's look at the other side of balance sheet. And like I said, the balance sheet identity is equal is assets equal to liability plus shareholder equity. So left-hand side should match the right-hand side. So we discussed assets. Now let's discuss the right-hand side, which is liability and shareholders' equity. So comparatively, let's start looking at, again, in the order of liquidity. We start with accounts payable. Now, this is exactly the reverse of accounts receivable. This is the amount that we have to pay to our vendors, and we haven't paid out. This is amount still owed by us. So obviously, as we've expanded from 2014 to 15, the amount that has to be paid out has increased substantially. Accounting-wise, it's good because we have used the product or the raw material and still haven't paid out. But obviously, it's not good in case we have extended or gone past the due date. So like a person, for example, if we have a credit card and we allow 30 days to pay any balance, and if we do not pay, it becomes account due, and that reflects bad on our credit profile, and the next time our interest rate jumps on the credit card itself, or the credit card could be canceled. Same goes for firms. If the firms are paying their bills as required, they're settling their bills as required, the suppliers would be very happy to extend additional credit. But if they default on payments, if they extend the payment due dates, like a person, their credit privileges might be cut short, or the interest charge should be bumped up. So accounts payable on paper, yes, it looks good, but then having too much of accounts payable also does not look good. Accruals are the various payments which are the liabilities which the business has to settle, but has, for example, in the case of rent, you pay once a year, or let's say lease. Rent wouldn't be a good example because rent you pay monthly. Lease would be a better example because lease happens once a year normally. So you pay out lease once a year, and this could be the amount that's now adding up to be paid or settled at a specific date at year end. So this also has increased from 14 to 15. For example, you may have leased some assets to manufacture goods. Again, it's a massive expansion coming from 14 now to 15. Now, as long as you can handle the debt, it's fine. The problem occurs when you cannot handle the debt. That is the main worry. So this could be looked into the context where banks are worried because this business may not be able to really handle the debt as far as possible. Notes payable. Now, there are two ways of taking loan. One is on short term, one is long term. And again, why do you take loan on short term is to, for example, cover your short term needs. Let's say, for example, the business has shipped goods to the customers, and the check may have been written and being dispatched. Maybe it's on the way, but you still have to, let's say, make payroll or pay utility bills. So what the business does is it'll issue or it'll take out notes, which is short-term loan. So the business would guarantee by a note saying, okay, I'll pay X amount back in so many days with so much of interest and so forth. So it's a note that the business is taken on a short-term basis, loan on a short-term basis. So the business has this amount to be paid in 2015. So it's a short-term loan, which obviously has increased quite a lot. It's almost three times since 2014. So total current liability, which is a short-term liability, you can say, has gone from 481,600 to 1.6 approximate million in 2015, almost I would say 4 times, which is quite a lot. Long-term debt is capital for capital projects, for example, building, plant, machinery. And sometimes analysts would say they are not really worried about the long-term debt, even though it is a signal of added risk to a business. But long-term debt sometimes can be managed because if it's a 10-year, 20-year loan, business conditions might change. The business might have a couple of successful products, and it might change the fortunes of the business. So the business does have some time to recover and take care of the long-term debt, the principal that has to be paid back. Main problem is the short-term debt, these notes payable. The business does not have enough time. For example, let's say the business shipped, $3 million worth of goods. And let's say for some reason it has a faulty battery pack. Like the case that happened with Dell a while ago, where its battery pack on its laptop was faulty, and that meant recalling a massive amount of batteries back. That resulted in heavy expense. So what if those $3 million of goods were rejected and sent back? Now, how does this company now take care of these short-term, loans that it has taken? That is the main worry for businesses. So always, look at the comparison between notes payable and long-term debt in that comparison. Long-term debt has gone up by almost, twice and some more. Common stock are the shares of the company in the market, which hasn't changed. So company decided to issue more of debt than stock for their expansion purposes. You can see that the common stock has not increased, in these 2 years. So the company decided that they'll go out and take long-term debt for expansion purposes, and to meet short-term needs, issue notes. Again, we have discussed this in earlier chapters. There are specific reasons why you would prefer to go through debt rather than stock, because if you bring more shareholders, obviously you have more people to answer. And in case of debt, it's simply a loan. There are some contractual terms, yes, but you are not answerable to the bank or financial institution who has issued this debt to you. You're only answerable as far as the contract is signed in terms of the contractual payments, like the coupon payment and so forth. Retained earning is the amount of cash that you decided to hold back from the earnings, and this has decreased substantially from 14 to 15. That's the reason why the shareholders are unhappy, because this has dwindled from almost 203,000 to 32,000. Total equity, this is the equity of the shareholders on book, which has gone down from 663,768 to 492,592. So we had discussed, the book value versus market value in the prior chapter. So this is the book value we had discussed. The book value going down would, if I were to give you a analogy in real life. So for example, let's say you own a car. On book, the value of the car might be 15,000 in 1 year, and then suddenly maybe, you painted the car from a silver to some bright yellow, and now nobody wants to buy that car, and the book value or the book value, for example, now because you painted to yellow suddenly drops the value to 12,000. Now in market, that is going out in market, if you want to still sell it, let's say they don't even want to consider the book value. Now they just want to offer 8,000. So that's even worse. So we will be discussing all these examples later on, but I just wanted to give you a brief synopsis on these financial statements. So the total of liabilities and equity is 286,659.2 in 2015. So this is the right-hand side, this number. Obviously, this number is going to be equal to, if we go back to the previous slide, it has to equal to the left-hand side, which is the total asset. So you can see that the total asset, this equation holds. Total asset should be equal to total liabilities plus shareholder equity. So let's move on to the income statement. Now, income statement will provide you with the information on the revenue and the expenses, the corresponding expenses that have gone through, and what is your net income. Again, we go systematically step by step, comparing between 2 years. So first is sales, obviously the total sales that the company made during the year. We can see in 2014, we had 3.4 million approximately, in 15, 6 million. So obviously because of expansion, we are seeing a higher sales figure. Now COGS is cost of goods sold. Like I said, it has to be a matching principle, corresponding principle. So the cost that went on to manufacture those goods which have been sold have gone from 2.8 million to 5.5 million. Other expenses, could be advertising, could be delivery charges, could be all other charges which you can look at as overheads and so forth, has gone up from 358 to 519. Total operating costs, excluding depreciation and amortization, has gone up almost double, from 3.2 million approximately to 6 million in 2015. Depreciation and amortization, remember we talked about depreciation being an expense, but this is a special expense because we don't pay out to anyone. It's a charge that the company retains for itself for the replacement of plant and machinery, so forth, for the wear and tear. So this has gone up from 18,900 to 116,000.